Hello, everyone. As introduced, I'm Lauren Neeno, a Target Date Fund Specialist here at RPAG and your Target Date Fund Tutor for the day. Thanks so much for joining me to discuss how RPAG looks at evaluating and selecting target date funds and stable value funds as well. For the first bit here, I'll be talking through the importance of target date fund suitability, and then I will get into RPAG's solution to documenting the target date fund selection process by running a plan fit analysis using RPAG's Target Date Fund Analyzer tool. And then I will wrap up with stable value funds and RPAG's Stable Value Analyzer tool as well. All right, Chapter 1, Target Date Funds. By now, we've all talked about the proliferation of target date funds and their growing popularity in our industry. And really, the combination of significant retirement plan balances and extreme down market return differences among like-dated target date funds warrants a comprehensive target date fund suitability and selection process to protect plan participants and mitigate fiduciary risks. There's just a little definition for you of why we think that this is a really important process for you to go through with your clients, and also why the DOL thinks it's an important process for you to go through with your clients. So first, it's important for us to remind our committees that we focus on the target date fund selection process because target date funds are one of the most widely used investment options in defined contribution plans, likely in their own plan as well. And really, most 401k plans within the industry are using target date funds as the plan's investment default as well. So with such proliferation, within the industry, the DOL recommends spending a little bit of time going through some of the education of what that landscape or the target date fund landscape looks like. Now, when considering different target date funds, it's important for us to keep in mind from a fiduciary standpoint that not all target date funds are created equally. They each have their own glide paths, so each target date fund manager creates their own stock and bond allocation mix and their own strategy for de-risking participants as they approach retirement. But again, each provider has their own asset allocation philosophy, and they all do it at different rates, giving us this large distribution of risk levels. So what we've done here is overlay the glide paths for the 100 plus various target date fund options available in the industry. And you can see that depending on which series is selected for the plan, there could be a difference in equity exposure at retirement of as much as 48%. So those large differences have absolutely led to a wide variety of outcomes for plan participants. I have some examples here. So as I mentioned, the differences between series can be pretty significant. And my first example is if you looked at what happened to 2010 dated target date funds during the global financial crisis. So this chart is from November of 2007 to February of 2009. So someone expecting to retire in 2010 is maybe 1 or 2 years away from retirement, maybe with one foot out the door from their job already. And while negative returns could have been expected over that time period, it's the difference in how much that we need to consider. So best case, you lost 10% of your portfolio. Worst case, you lost 51%. And that really got a lot of people thinking about the differences in risk that are associated with target date funds. Sometimes, as an example, I like to think about two neighbors, both maybe 64, 65 years old, right, ready to retire in maybe 1 or 2 years, both fully invested in their company's retirement plans and similarly funded for retirement. The one who lost 10% may still be able to retire close to on time, but the one that lost half of their account balance is likely going to have to delay retirement. And I think the most important thing to note here is that these two neighbors likely expected to have pretty similar returns performance from their 2010 dated target date funds. We also saw similar trends throughout February and March of 2020 at the onset of the COVID pandemic. At the time, those participants invested in a 2020 dated target date fund, at worst, we're down around 24%, but at best down 8%. So similar differences in performance for equally dated target date funds. Another key here is that participants approaching retirement may not always have the luxury to wait for the market to rebound. Oftentimes people say, yeah, we'll just wait a little bit. They have sharp rebounds, but health, caretaking of loved ones, family obligations, etc., they're all factors that really should not be dismissed when timing when to retire. So where is this all going? The Department of Labor actually came out with guidance for fiduciaries on what our process should look like when we select and monitor target date funds for a company's plan. And what we've done is really summarize that guidance here. So keep in mind as you read through maybe some of these bullet points that none of the tips are necessarily specific to performance. They are all specific to this concept that we need to align the target date fund to participant characteristics. So looking at the bullet points here, that first one, aligning the target date fund and participant characteristics, RPAG's approach to this is assigning every target date fund in the universe a risk rating of either conservative, moderate, or aggressive by looking at various equity points along the glide path. And then we run the fit analysis to determine, is the average plan participant best suited for a conservative, moderate, or aggressive target date fund? And then we match those two up. So next up, understanding underlying investments. We absolutely take into consideration the DOL's guidance of understanding the underlying investments. That's seen in our RPAG scorecard that highlights the importance of the underlying funds with our blended score approach for target date funds. The underlying funds can also be active, passive, or a blend of both. They can be proprietary funds, or the series can use an independent investment selection approach. So all things to consider when looking at the underlying funds of a target date series. Next up, review fees and investment expenses, as we do, with any core lineup fund. And then I think the next bullet point is actually the DOL's acknowledgement that the plan doesn't necessarily need to use the cheapest option available, which I think many fall prey to when thinking about investments. So considering something custom or non-proprietary. You may know the FlexPath story, but a little shameless plug here. We've had some massive success with FlexPath's custom solutions business, very much attributable to you and your clients. In 8 short years, we've surpassed 40 billion in assets under management. And in fact, according to the 2023 Sway research report, we are the largest multi-glide path target date fund manager in our industry with 89% market share. And we are the fastest growing target date fund manager over the last 3 years with 31% average annual growth in assets under management. So thank you for your support in building up FlexPath. I'd be remiss to not mention that when talking about reviewing custom target date solutions. And then lastly here, developing effective employee communications and of course, documenting the process. So again, if the DOL recommends spending some time documenting a process for evaluating and selecting target date funds, we are doing it. And the plan fit analysis is how we do that. It's an analysis that considers plan demographics and participant tendencies in order to identify a best fit risk profile for a plan. So conservative, moderate, or aggressive. And determining that best fit risk posture is really the first decision that we should be making when selecting a target date fund for a plan. For the QDIA or the default investment offering, this risk level should align with the needs, again, of the average plan participant determined in the fit analysis. So going back to that first bullet point from the DOL's tips. For example, the average retirement plan could likely benefit from a moderate target date fund approach, but we need to conduct due diligence to be sure there isn't a reason that the plan should maybe consider a more conservative or aggressive option. A plan with high savers that are well funded for retirement may need to consider a more conservative target date fund. And then vice versa, a plan with low savers who are underfunded for retirement may need to consider a more aggressive target date fund option for the plan as a whole. This is also a good time to mention the FlexPath outlook on the multiple glide paths. So a traditional target date fund would only be able to offer a single glide path that is unlikely to satisfy the needs of every plan participant. So a participant's age would be the sole determining factor for their asset allocation. But with a custom target date fund through FlexPath, the plan would be able to offer multiple glide paths to satisfy all participants' needs and desires to take risk. So how do we run the fit analysis and determine that best fit risk profile for a plan? Well, I'm going to walk you through that. And this here is step one, collecting the data for the analysis. You can either send some type of RFI out to the plan's record keeper, or you can just request their most recently generated standard plan review that each record keeper puts out specifically for that client. So this is an example on the screen here of the RFI that the FlexPath team will send out when running an analysis for a plan. But you can create your own if you would like, or you can request ours as well. Once you've collected the plan data, you can go into the RPAG system, open up the main menu, and then under Tools, select Target Date Fund Analyzer to run your fit analysis. Here, you'll answer a few simple questions using the information that you collected from the record keeper. You can see that there are 3 different decision trees, so plan objectives, plan demographics, and participant behavior. And each of these decision trees in the bottom right-hand corner will show a conservative, moderate, or aggressive result depending on how you answer those questions. And then finally, the tool will automatically average the results of those 3 decision trees to come to an overall best fit risk posture for the plan. In this example, one decision tree was conservative, another was aggressive, and another was moderate. So the average of that is a moderate approach being the most appropriate for the average plan participant with this fact set. And then your final step is now selecting. So again, the result was moderate for the average plan participant. So your final step is to select a few moderate target date funds to include in the report to compare against the client's incumbent series. It doesn't necessarily mean you have to move. Again, the plan fit analysis is a great due diligence piece to document a fiduciary process for the selection of your target date funds. And I also like to mention that it can be used for prospecting as well, bringing something a little bit unique to the table, saying, hey, look at our process that we've established as fiduciaries. So some of the key takeaways from the target date fund chapter 1 here, target date fund prevalence really necessitates increased due diligence by fiduciaries. We must conduct due diligence and research and document a fiduciary process for how we evaluate and select target date funds for any of our clients' plans. For a reference point, we aim to run the plan fit analysis every 3 to 5 years or as needed. So maybe the plan went through maybe a merger or an acquisition. At that time, that would be another good time when the plan's fact set can change significantly to reevaluate the plan as a whole, rerun that fit analysis, and determine again the best fit risk profile for the average plan participant. And then finally, leverage the Target Date Fund Analyzer tool in the RPAG system to quickly run an in-depth analysis on your client's plan and their current target date fund offering and other target date fund considerations. All right, moving on to chapter 2, stable value funds. So I wanted to start here. First up, on a quarterly basis, how do you review and document your due diligence of your client's current cash fund. Well, for that, RPAG creates these 2-page custom fact sheets for stable value and GIC funds. In these fact sheets, you'll get information on credit quality in the portfolio, performance with market to book data, and of course the crediting rate and how that's done over time relative to the universe median. So these are really a great way to document due diligence on a plan's cash fund. And because many investment contracts or GICs can't really report on any of these portfolio stats until after the parent company reports earnings, the stable value fact sheets are typically available about 1 month after the quarter end, and they continue to trickle into the system throughout the quarter. So just as a heads up there, you'll see updated data about a month after quarter end for some of these fact sheets. So what can be used to present the decision-making criteria, or in other words, how did you come to selecting this fund for a plan, or maybe even the plan is moving record keepers and you need to select a new cash fund? The Stable Value Analyzer is a great tool to look into the universe of cash funds and run a comparison report for your clients to document the process for selecting the fund, or even just for research. You can find the Stable Value Analyzer under the main menu, then Tools, then Stable Value Analyzer. There are 2 different report options under the Stable Value Analyzer tool: the Stable Value Analysis and the Custom Stable Value Comparison. And the way these 2 differ is that the Stable Value Analysis is going to take you through a questionnaire at the beginning to really help you decide and filter down which funds you would like to compare. Whereas the Custom Stable Value Comparison gives you the full universe list of funds, and you just choose which ones you'd like to see in the report. So the Stable Value Analysis just has an extra step at the front end. And here you see that first step. So this is pretty cool. You can input your preferences or your client's preferences, right? See what's most important to your client and be able to filter based on, credit quality or credit rating. So for example, you can say, I want to see funds with a crediting rate greater than 2%, and I want to say that we prefer funds to have a greater credit quality than BBB+, and so on. You can move through this entire list if you wish to put in preferences, or you don't have to fill any out at all. But then on step 2 of the analysis, by default, the system will sort the funds by the number of criteria that are met from the questionnaire that you filled out in step 1. So from here, you would then select which funds you want to compare in the report. You also have the option to specify which fund is the incumbent, and you can include industry comparisons to the stable value or GIC meetings as well. And then in step 3, you would move on to building the report as you would for any other report in the RPAG system. This tool is super user-friendly, so even if you aren't super familiar with stable value funds already, I like to use it as an educational tool as well to dive into these cash equivalent vehicles. I also thought I would show a sample of the stable value matrix comparison slide from the report output, because I think it's a nice summation of the information throughout the report. The report itself goes in depth on each fund you selected. It looks at the quality of the underlying bonds, the risk return data, market to book, fees, sector diversification, fact sheets, etc. The list goes on and on. But overall, I think it's a very in-depth report that you can bring, again, for prospecting or for due diligence pieces to your existing clients. So overall, RPAG has some wonderful resources for all of your stable value needs and target date fund needs, as we went over earlier. As always, if questions come up later, please reach out to RPAG support. We're always happy to help you.